Welcome back. Are you dreaming of becoming a confident, successful investor? If yes, then you are at a right place. Whenever we talk or think about investment, a name comes in our mind, Warren Buffett, and all of us always wonder that how Warren Buffett became one of the most successful investors of all time? Well, the answer might surprise you. It all starts with a book, The Intelligent Investor by Benjamin Graham. Today, we're cracking open this classic and uncovering the timeless principles that can help you outperform the market, just like Buffett himself. This book, The Intelligent Investor, is considered as the Bible of value investing. Graham, a mentor to Warren Buffett, outlines his philosophy of buying stocks for less than their intrinsic value. Let's get inside the book without any further ado because your time is most valuable. We will divide this journey in the form of chapters for better understanding. Chapter 1, The Essence of Investing. Graham introduces the concept of the intelligent investor versus the speculative investor. He emphasizes the importance of a disciplined, long-term approach to investing. The intelligent investor focuses on buying stocks when they are undervalued, considering them as partial ownership of a business rather than mere pieces of paper. For example, imagine you're considering investing in two companies, Company A and Company B. Company A has a solid track record of consistent earnings and a healthy balance sheet, while Company B is a startup with uncertain prospects. The intelligent investor would lean towards Company A, recognizing its stability and intrinsic value. Chapter 2, Mr. Market and Market Fluctuations. Graham introduces Mr. Market, a fictional character representing the stock market's manic depressive behavior. Mr. Market offers to buy or sell stocks every day at various prices, often influenced by emotions rather than fundamentals. The intelligent investor takes advantage of Mr. Market's mood swings, buying when prices are low and selling when they are high. For example, consider the recent market downturn due to a global economic crisis. Mr. Market panics, driving down stock prices indiscriminately. The intelligent investor sees this as an opportunity to buy high-quality stocks at bargain prices, knowing that market fluctuations are temporary. Chapter 3, Margin of Safety. Graham emphasizes the concept of margin of safety, which involves buying stocks at prices significantly below their intrinsic value. This provides a buffer against unforeseen risks and market downturns, reducing the probability of permanent loss. For example, imagine you're buying a house. The market value of the house is $300,000, but you negotiate and purchase it for $250,000. This $50,000 difference serves as your margin of safety, protecting you from potential declines in the property's value. Chapter 4, The Defensive Investor versus the Enterprising Investor. Graham distinguishes between two types of investors, the defensive investor and the enterprising investor. The defensive investor prefers a passive approach, focusing on diversified portfolios of low-cost index funds. The enterprising investor, on the other hand, is willing to devote time and effort to analyze individual stocks and seek higher returns. For example, suppose you're a defensive investor with limited time and expertise. You choose to invest in a low-cost index fund that tracks the performance of the S&P 500. This allows you to achieve broad market exposure and diversification without the need for extensive research. Chapter 5, The Investor and Market Fluctuations. Graham discusses how investors should react to market fluctuations. Rather than being swayed by short-term price movements, investors should remain rational and focus on the underlying fundamentals of the companies they own. For example, during a market downturn, many investors panic and sell their stocks at depressed prices. However, the intelligent investor stays calm and assesses whether the companies they own are still fundamentally sound. If so, they may even take advantage of lower prices to buy more shares. Chapter 6, Portfolio Policy for the Enterprising Investor. Graham outlines portfolio strategies for the enterprising investor, emphasizing the importance of diversification and asset allocation. By spreading investments across different asset classes and industries, investors can reduce risk and enhance long-term returns. For example, an enterprising investor decides to build a diversified portfolio consisting of stocks, bonds, and real estate investment trusts, REITs. By allocating a portion of their assets to each asset class, they can achieve a balanced risk-return profile tailored to their investment objectives. Chapter 7, the defensive investor, and common stocks. Graham provides guidance for defensive investors seeking to invest in common stocks. He recommends focusing on large, well-established companies with stable earnings and dividends. Additionally, he advises against market timing and excessive trading, advocating for a buy-and-hold approach. For example, a defensive investor chooses to invest in blue-chip stocks like Coca-Cola and Johnson & Johnson. These companies have a long history of profitability and dividend payments, making them suitable for conservative investors seeking income and stability. Chapter 8. The Investor and Market Fluctuations, Part 2. Graham revisits the topic of market fluctuations, emphasizing the importance of psychological discipline in investing. He warns against succumbing to greed during bull markets and fear during bear markets, urging investors to maintain a rational, long-term perspective. For example, during a prolonged bull market, many investors become overconfident and take excessive risks. They may borrow money to invest in speculative stocks or leverage their portfolios with complex financial instruments. However, when the market inevitably corrects, they suffer significant losses. Chapter 9. Investing in investment funds. Graham discusses the pros and cons of investing in investment funds, including mutual funds and closed-end funds. While funds offer diversification and professional management, they often come with high fees and limited control over investment decisions. For example, an investor considers investing in a mutual fund that focuses on technology stocks. While the fund promises to deliver above-average returns, it charges a management fee of 1% per year. Over time, these fees can erode the investor's returns, especially if the fund underperforms. Chapter 10. The Investor and His Advisors. Graham offers advice on selecting and working with investment advisors. He cautions against blindly following the recommendations of financial professionals, urging investors to conduct due diligence and ensure alignment of interests. For example, an investor seeks advice from a financial advisor who recommends investing in high-commission products like variable annuities and proprietary mutual funds. However, upon closer examination, the investor discovers that these products generate hefty fees for the advisor but offer limited benefits. In the end, here are some short but worthy lessons for our viewers from this book. Number 1. Be the intelligent investor. Don't panic with market swings. Focus on a company's intrinsic value like a savvy shopper. Number 2. Research like Mr. Right. Analyze financials, PE ratios, and debt levels to find undervalued gems. Number 3. Choose your strategy. Play it safe with defensive investing in stable companies or seek growth with enterprising investing after careful research. Number 4. Control your emotions. Don't be swayed by Mr. Market's moods. Invest for the long term and stick to your plan. Number 5. Become a value investor. Buy stocks for less than they're worth and watch your portfolio blossom over time. That was all for today. Implement these points and share your opinions in the comments. And if you like the video, then subscribe our channel because it motivates us as we always make research-based content to play a positive role for society. Thank you.